Hello, everyone, and welcome back for another Indie Wealth Monthly Market Update. As always, I'm your host, Nathan Zimmerman. Today, we'll be reviewing the volatile month of March, the first quarter overall, and what to look forward to next. So for the month of March, the S&P 500 was down by about 5%. Unless you're living under a rock, you probably saw the headlines and understand why. Most of the volatility was a direct result of the conflict in Iran. The biggest impact was on oil prices, which jumped from around $65 per barrel to over $100 per barrel. 20% of the world's oil passes through the Strait of Hormuz, which is effectively controlled by Iran, and the passage of oil tankers through that waterway has pretty much ground to a halt. Obviously, economies require energy to go, and we're a world that runs on oil, so you can understand the concern. Now, we'll get back to this story in a moment, but first, let's zoom out and discuss stock market performance. Now, taking a look at the chart above, we can see how the various sectors of the market have performed year to date. In the middle, the blue bar, we see the S&P 500 showing a year-to-date return of negative 4.6%. But not all sectors have experienced declines. On the far left-hand side, we see that the energy sector has had an incredible start to the year, up 37%. Now, while war may not be great for the market overall, energy companies have seen substantial gains as oil prices have risen. Now, on the other end of the spectrum, we see that technology has been one of the major laggards, down 9% for the year. While that may seem pretty bad, it's important in times like these to zoom out. So let's do that. Now, while the previous chart showed year-to-date performance, this chart shows the trailing one-year performance. We can see here that despite the recent correction, the S&P 500 is actually still up more than 16% over the past 12 months. And technology, which we just saw as one of the worst performing sectors over the first 3 months of this year, is still up 28% over the trailing 12 months. Now, this is why it's important as long-term investors to maintain a longer-term perspective. If we focus on short time frames, it's easy to become frustrated or discouraged. It's easy to focus on what's happened recently. It's a known human behavior called recency bias. But if I had told you a year ago that over the next 12 months, the S&P 500 would return 16%, we'd have been thrilled. And zooming out even further, the total return for the past 5 years for the S&P 500 is now over 80%. And those are the time frames that we should be more focused on as long-term investors. There's always going to be volatility in times where the market is below its all-time highs. That's just part of investing. But over the long term, all of those periodic corrections that felt painful at the time turn into blips on the radar. And you can see all of those recent blips pretty clearly in this chart of the S&P 500 over the past 10 years. During this time, we've experienced multiple corrections, contentious elections, the 2018 trade wars with China, COVID in 2020, the ensuing inflation spike and bear market in 2022, the tariff tantrums from last spring, and now the war in Iran. There have been so many periods of time over the past 10 years alone where it probably felt like the sky was falling and our portfolios were taking a hit. But despite all of that, the S&P 500 has more than tripled in value over that same period of time. Now, I don't know about you, but I'll happily accept those periodic bouts of volatility in exchange for those long-term returns. And that's the mindset that we have to have as long-term investors. So why is the market reacting so poorly right now to the war in Iran? Well, it has a lot to do with oil, as I said earlier. 20% of the world's oil passes through the Strait of Hormuz, which is adjacent to Iran, and they've effectively closed off that waterway during this conflict, and this has caused a supply constraint, which has caused oil prices to spike. Now, the concern here is that an elongated conflict could cause oil prices to stay higher for a long enough time that it starts to weigh on economic growth. We're an economy that is driven in large part by consumption, folks just like you and me spending money. But if we're forced to spend an extra $50 every time we visit the gas station, that's $50 less dollars we have to consume other goods and services. Now, if that were to go on long enough, it could start to be a noticeable drag on overall economic activity. And the other concern is that higher oil prices could cause prices to rise in other areas of the economy. Higher energy costs feed through to a lot of areas of the economy. And if those costs stay elevated, it could cause overall inflation to start rising again, which, as we saw in 2022, was not a great thing. But I think the expectation is that this will not be a long, protracted conflict and that this energy shock will be relatively short-lived, as have most of the energy shocks in recent history, as you can see in this chart. This is not something that we haven't seen before. Oil has hit levels similar to these several times over the past 20 years, and eventually it has settled down. And when things do start to settle down, I think we'll start to see the stock market settle down and react more positively as well. Just take the final day of March, for example. We got some headlines that the US and Iran may be making progress in negotiations to end the conflict, and oil prices fell 5% in the blink of an eye, and the markets rallied significantly. This is also a prime example of why it's important to just stay invested and not try to time the market. Things can switch directions on a moment's notice. If you sell and think, well, I'll just sit on the sidelines and wait for things to calm down, you may end up being on the sidelines while things start to dramatically improve and then be forced to buy back into the market at much higher prices. It's best to just stay calm, stay patient, and stay invested. We saw in the charts earlier that these bouts of volatility over the long term tend to look like blips on the radar. We don't need to time the market perfectly. We just need to spend more time in the market. So that's going to be it for me this month, and I'll be back with a written mid-month update in a couple of weeks. In the meantime, please share these videos with any friends or family who may find them useful. An easy way to do that is to follow us on Facebook and just hit the share button on the post of this video. Each month, I'll be randomly selecting someone who shares these videos to receive one of our Indie Wealth hats or travel mugs. So please go check us out on Facebook and like and share these videos. Thank you.